Okay, good afternoon and welcome back everyone to our options education webinar series. Today we're going to be talking about how to trade earnings with limited risk. This is a pretty timely webinar, I would say, given today's price action. You know, we've seen a major sell-off in the market. I actually think that this is a bit of a precursor to some of the volatility that we might see in this upcoming quarter, especially with earnings season kicking off this week. We're going to start seeing some pickup in earnings next week. I think I really want to take the time out and make sure that everyone understands, you know, what to expect this earnings season, even if you're not trading it. But if you are trading it, number one, how can you minimize your risk by and specifically limiting your risk if you're going to trade earnings, and then making sure you understand how to analyze a trade correctly so that you can anticipate what may happen over earnings and see how different option strategies will perform based on your given views of the underlying stock. So we'll take a few minutes today going through the individual slides. This webinar is recorded, so the slides will be taking up about 15 to 20 minutes going through some of the basics about what trading earnings are, how to go about doing it, best practices. But what I really want to spend most of the time on here today is actually showing you Options Play, which is the tool that you guys have access to free of charge here at Firstrade that allows you to really dive into option strategies, making sure that you understand how to analyze them, and showing you how to utilize the tools so that you can become self-sufficient in looking at option strategies by yourself. Before I get started, I just want to remind everyone Firstrade recently introduced zero commissions on all stocks, ETFs, and options and mutual funds. This is really going to be useful, especially for those of you that are active options traders, because as you might know, options trading, they tend to trade in smaller dollar amounts and with larger commissions. So meaning you're eating up a larger percentage of your trade into commissions when you're trading options versus trading stocks. So by reducing the options commissions to all zero, you're not paying any of that. So that's really going to be a big game changer in the cost of trading options, especially when you're buying calls and puts for just a few $100s at a time. Lowering your commissions down to zero is going to have a huge impact on your bottom line. Also, just a reminder that Firstrade recently won Kiplinger's #1 online broker, best online broker for ETF and bond investors. So great platform for you guys here that's available to you. Options Play is included free of charge. So that's where we're going to spend some time here today and walk you guys through that. So today I'm going to start off by going through a little bit about earnings season preview, giving you an idea as far as what happened last quarter and what we expect to happen this upcoming quarter. We'll then cover what trading earnings even means, why you should consider trading earnings, and more importantly, how can you trade it effectively. So through this process, we're also going to explore a little bit about option pricing, understand how option pricing is affected around earnings is really important in order to trade these strategies. So in order to do that, what we're going to do is we're going to go through some live examples of real strategies and real stocks and showing you some bullish and bearish examples of how to take advantage of a bullish or bearish move on an earnings announcement. So before I get started, my name is Tony Zhang. I'm the Chief Strategist here at Options Play. I'm here to help you guys better understand not only how to trade earnings, but also the tool that's available to you free of charge. So before I get started, I just want to do a quick check of who's in the room. If you've traded earnings before, please type yes into the chat window. If you've never traded earnings before, please type no, just so I get a feel for the audience here in the room. Okay, so it looks like I have a fair amount of no's, which is great. You know, this is really what we're here for, is to really help you guys learn. So for those of you that are brand new to trading earnings, welcome. It's certainly an exciting yet risky endeavor. So we really want to make sure we understand the risks with trading. And for those of you that have traded earnings, I'm sure you understand that this is a very volatile time. So we really want to make sure that you understand how to limit and manage your risk around trading earnings. So to get started, I just want to do a quick Q3 earnings preview. And before I do that, I'm going to start off by talking a little bit about what we saw in Q2. Q2 was one of the strongest quarters on the books. Record beats on both sales and revenues. Top line and bottom line growth was one of the fastest in history. and we had what I would consider is peak profit growth, because we are seeing profit growth rates slowing down. This is typical of a late cycle. We are 9 years into a bull market. This type of profit growth slowing down is typical of a late bull cycle. And more importantly, what we saw in terms of price action was that stocks that beat their earnings announcement or beat their earnings expectations had relatively muted positive gains, meaning stocks that beat were not really outperforming. However, stocks that missed their earnings announcement or missed their earnings expectations had huge negative reactions. And this is also, again, very typical of late stage bull cycles. So it's really important to kind of understand where in the larger business cycle we are. With a 9-year bull cycle, doesn't by any means mean that it can't go on for another 2 years or 3 years or even longer than that. However, we do start to see some of these late cycle characteristics like the profit growth start slowing down and the fact that stocks that beat are not really outperforming. So with that, taking a look at what we're expecting for Q3 and in the few early reports that we have seen, we are still expecting a fairly strong quarter in terms of both revenue and profit. We are expecting a modest beat across the board for most S&P 500 stocks. What's interesting is that we've seen a huge slowdown in analyst expectations over the last month, specifically since we've had the whole trade wars and tariffs that have been implemented on Chinese goods. We've seen a huge reduction in analyst expectations in the month of September. What that means is that it kind of sets the bar a little lower, and that tends to be a little better for the percentage of stocks that will end up beating their earnings expectations. And the key theme that we really want to focus on in Q3 is understanding how wage inflation has compressed margins for Q3 earnings. Last week we saw some pretty big news that Amazon was moving all of their hourly employees to $15 an hour. This is a trend that we're seeing across the industry as the unemployment rate is quite low while the economy is still quite strong. Companies have to pay more to attract talent. This is causing some margin compression on company bottom lines. So this is something that we expect to see some impact, especially for companies that have large human capital or a large number of employees. So those are some of the things that we want to look out for Q3. And scanning for some of the best sectors for Q3, best and worst sectors, looking at which sectors are getting the most upward revisions where analysts are revising what their expectations are higher and higher on both sales and earnings. We're seeing that in healthcare, industrials, and technology stocks. I know today put a bit of a damper on some of these things, but however, a sell-off like today, as impactful as that might be for your portfolio, certainly does bring a lot of the lofty valuations that we've seen in the market back a little bit towards earth, if you will. And that might actually provide some catalyst for some buying. Hard to say what's going to happen, but I guess only time will tell. On the flip side, for downward revisions, we have this new sector now, the communications sector, that was carved out of some technology stocks and some telecommunication stocks and some consumer discretionary stocks into a new sector, communications. This is a sector that is scanning relatively poorly at the time, at this current moment. So is consumer staples as well as financials. Even though we're in a rising interest rate environment, we are seeing some pressures on some of these types of sectors going into Q3. So that just gives you a recap of what has happened, what is the themes that we're seeing in the market, and what our expectations are for Q3. So now that we have a pretty good idea as far as where we think, where the opportunities are, where volatility might pick up, let's take a look at what trading earnings even is. So what are earnings? Earnings are simply the reporting of revenue, profits of a company, and when the company provides forward guidance as to what they see is going to happen in the future. We see that right now a lot of the market is trading heavily with forward guidance as the indicator as to whether stocks outperform or underperform after an earnings announcement. we tend to see stocks aren't really reacting a lot to the revenue and profit numbers. They're reacting much more to how the company guides going forward. So a really important thing to look out for when viewing some of these earnings expectations or earnings announcements from these companies. Now, why should you consider trading earnings? Now, this is really for those of you that like to take risks. Earnings is a great way to take that risk because it creates a tradable binary event with extreme volatility. When a stock beats its earnings expectations, it tends to jump higher very, very quickly, effectively, instantaneously overnight. And then stocks that miss earnings will instantaneously fall substantially, anywhere from a few percent down to as many as 10, 20, or even 30%. We've seen big moves like that on big misses. So this type of big move is attractive if you're on the right side of that. So how can you be on the right side and if you're on the wrong side still have limited risk? And that's really where options comes in. Options provide you with this asymmetrical risk of providing that upside or downside depending on which side you're expecting the stock to move. But in the case the stock moves against you, or if it moves in the opposite direction that you expect it to, you have limited risk. And that's really one of the key reasons why I myself like to trade options, because when I'm right, I get to participate in that direction, but when I'm wrong, I get to limit the amount of risk that I take. So buying calls and put contracts allow me to speculate in the direction that I'm expecting the stock to move. However, it keeps me from losing my shirt, because the amount of money I pay for that call and put is the risk that I take with an earnings play. So a little bit about option pricing around earnings. This is one of the most important things that you first must understand before you can trade earnings. And this is really around how you can even profit from an option around earnings, because when you're trading earnings, it is by all means a very risky strategy. And the reason that it's risky is because you always have two things working against you and only one thing working in your favor. So I call it one step forward, two steps back when you're trading earnings. You always have kind of the tide working against you. So you really have to call a direction correctly in order to make money. So when you're trading an earnings strategy, you really have to call a directional move correctly, and it has to be a large move in one direction or another. So if you're expecting the stock to beat on earnings, then you have to buy a call option and hope that the stock moves a substantial amount immediately after earnings. If you're bearish on a stock or you think the stock's going to miss, you must buy a put option and hope that the stock makes a large move downwards. However, during this whole process, while you are holding on to that call or a put, there's two things working against you. Number one, there's volatility crush. So the implied volatility of an option, which is the uncertainty factor of what's going to happen in the future, is very, very high. So implied volatility is very high prior to earnings when you've purchased the call or a put. And once the earnings announcement comes out, that uncertainty goes away. So what happens is volatility of that, the implied volatility of the option will collapse. We call this the volatility crush after the earnings announcement. So when you trade a call or a put, the volatility crush is going to work against you by reducing the premium of the call or a put that you own. And secondly, you always have time decay working against you. So when you own an option, time decay is always working against you. And that's why when we're trading options with respect to earnings, we want to be in those trades in a relatively short amount of time, because the longer you are in it, the longer time decay works against you. So when you have volatility and time working against you, you must make a much larger move back on the move of the underlying stock in order to profit. So in order to profit from earnings, you must have a large move in the underlying stock, and that move must be large enough to overcome the volatility crush and that time decay that's working against you. So how do we actually measure these three things? How do you know how much money you're going to make from the underlying stock moving so much? How do you know how much money you lose to volatility? And how do you know how much money you lose to time decay? And that's where the option Greeks come into play. How many of you are familiar with the Greeks? If you are, please type yes into the chat window. If you're brand new to the Greeks or you don't know what they are, please type no into the chat window, just so I get a feel for who's in the room. Okay, great. So it looks like a vast number of you have said no, and that's okay. So I'm glad I'm covering this topic. So option Greeks, when the stock moves a certain amount, you want to know how much money am I going to make from the option. These are all terms that can be expressed in what we call the Greeks. Now, the Greeks sometimes can be confusing, and it involves some numbers. And this is really where some people tend to get a little scared off about options. But I want to make sure that I keep this at a high level so that I'm not scaring anyone off. And I want to make sure that you guys understand that you don't have to manually calculate any of these things, because the tools that are available to you at Firstrade with Options Play do these calculations for you. And that's really what I want to show you guys here today, is how Options Play makes your life a lot easier so that you don't have to do any of this math, but still get all of the benefits of understanding, right, how the stock and volatility and time affect your option pricing. So when we talk about a large move in the underlying stock, if the stock moves 10% higher or 10% lower, how do you know how that impacts your option price? And that's really what delta tells you. Delta tells you the change in the price of the option with respect to change in the stock price. So when you see an option that has a delta of 0.50, what that means is for every dollar that the stock moves, the option price will move 50 cents. So if you buy a call option and the stock goes up by $10, you should expect the option price to go up by half as much, $5. Okay, that's what delta tells you. But again, you don't have to calculate this. Options Play will actually calculate for you what the option price will be worth depending on where you think the stock's going to go. The second part that we talked about, this volatility crush. So when implied volatility or the uncertainty factor goes down right after earnings, we see that the implied volatility option will decrease in value. So how does that impact your option price? That's what Vega tells you. Vega will tell you, expressed if Vega is 0.25, means that for every 1% reduction in the volatility, you're going to lose 25 cents on the option itself. And lastly, theta, we talked about time decay. As the time approaches expiration, your option value will continue to erode in value. Theta tells you how much it's going to erode by. And that's where you get a theta of 0.10 will tell you that the option will lose 10 cents a day for each day you hang on to that call or a put option. So as you can see, this allows you to calculate how much money you would lose to volatility, how much money you lose to theta, and how much money you either gain or lose based on the underlying stocks. These are the three most important factors to understand when you're trading earnings, because these are the three biggest impacts to the option pricing that you're going to be trading around earnings. So that's really where I want to spend some time, and now taking a look at a little bit about the trading strategies themselves, the different strategies you can trade, and then what I really want to do is jump into some real examples to help solidify some of these slides that I'm showing you here. So when you're bullish or bearish on a stock going into earnings, there's really two strategies that you can deploy here, especially if you're relatively newer to options trading. So first of all, the simplest strategy is simply buying a call or a put. Buying a call if you're bullish, buying a put if you're bearish. This strategy gives you unlimited profit potential. So if the stock goes up $100 or $1,000 or all the way to infinity, you will participate in that upside for that stock, or if it goes down to zero, you will participate all the way down to zero. This is a strategy suitable for if you're expecting a big move. So if you have some stocks that you think that are really going to blow it out of the water, maybe they have some product announcements or products that are coming out that you think are doing really well. These are the types of strategy. Buying a call or a put is suitable for when you're expecting a large move in the underlying stock. Now, this strategy does typically put a larger amount of capital at risk compared to the next strategy that I'm going to show you here. So the second strategy that you can also deploy is what is a call vertical or a put vertical, a spread trade. So someone asked before, can you trade spreads to capture that volatility crush? So this is really where a spread trade can help you do some of that. Now, the only downside to buying a call or a put is the fact that it has limited profit potential. So this is for if you expect a modest or perhaps a slower move in the underlying stock. So some stocks, especially blue chip stocks, when they beat on earnings or miss on earnings, they may not have such a large reaction, and sometimes the reaction comes a few days after or maybe even a week after. There's a bit of follow through. So when you expect a relatively muted expectation on a stock, or you think the stock's not going to make a 10% jump overnight, it might make 3, 4, 5% jump, that's when you might want to trade a call vertical or a put vertical because limited profit potential. This is really for the stocks that you just simply don't think is going to make that 20% move. And what this does is it puts a smaller amount of capital at risk. So by limiting your upside, you will be able to take this trade or take that directional bet while risking even less money. And that's really what we're going to do here is we're going to compare buying a call or a put to a call vertical and a put vertical in the few examples that I'm going to show you here today. And lastly, it's really important that when we're trading earnings that we pick expirations that are suitable for the earnings date. That's the one thing you want to make sure that, and number one, you include the earnings date within the expiration that you're trading, because if you have an earnings coming up in November, but you're trading an October expiration, then you're not going to capture that earnings announcement. So making sure that you trade an expiration that's at least 1 to 2 weeks after the earnings announcement is important for deciding which strategies to pick. So with that, let's actually jump over to options play. I want to show you some real examples of some stocks to really put what I'm teaching you here today to use and making it more tangible for everyone. So first of all, welcome everyone. For those of you that have never seen options play, you can launch options play from your Firstrade account. You can launch it by going to the trading tab. Under the options trading tab, you can click on a button here on the right that says Options Wizard. When you click on that, that's going to launch Options Play. And this is a free tool available to everyone so that you can better analyze option strategies. This is designed to make your life a lot easier when it comes to analyzing option strategies, viewing the charts, viewing everything that you need to make a trading decision all on one screen. Compared to using an option chain such as this, you're going to find that what you have is just a lot of numbers. Now, for those of you that have never used it, this is what you would use to pick a call option or a put option. And picking calls and puts off of an option chain is certainly no easy task, especially if you're brand new to this, because all you see is a lot of expirations, a lot of strike prices with a lot of numbers next to all of them. And most people may not even understand what all those numbers mean. And that's really why we created options play. So if I'm looking at AT&T here and I'm expecting AT&T to go up 5% on earnings, how do I know which strategy to pick and what my outcome will be if the AT&T goes up by $5? You can't do that from an option chain, and that's really why we created Options Play. This is a tool that's designed to help you not only understand what's currently going on with the underlying stock, but also provide you with different things like trade ideas and watch lists, so fresh ideas for you every single day to look at, watch lists based on the individual sectors so that you can take a look at what's going on in each individual sector, and then showing you, more importantly, how to look at different option strategies that are already picked for you as starting points. And this is really one of the things that a lot of beginners tend to struggle with options, is where to actually start. You might learn about a call option, you might learn about picking expiration dates and strike prices, but once you're staring at one of these chains, it really becomes difficult to understand where to start. And that's why we created this tool that allows you to actually pick picks starting points for you so that you can start exploring and learning before you start modifying and playing around with different strategies or different expirations and strike prices. So what I have here is I have AT&T up, and I brought up AT&T. There's no particular reason here for me picking this stock. This is not by any means a solicitation to trade this stock. I'm simply bringing this stock up as an example. And this is a relatively neutral stock in the telecommunications sector that we talked about. Relatively weak sector. It really, it's starting to turn weaker a little. It's closed at $33 for this particular trade. And so I wanted to see, what are some possibilities on AT&T? And I don't really have a view on the stock per se, but it is in a relatively weak sector. The technical score is neutral, so it's not a strong stock or a weak stock. And it's got earnings coming up in 2 weeks on October 23rd. So I wanted to take a look at maybe some bearish strategies on AT&T, because it looks like it's forming a bit of a double top here around that resistance level around 34. So maybe this is going to form a double top and maybe fall back down to 31. That's just a guess. I have no idea if that's going to work out or not, but let's see how we can play that if this thing does form a double top and beat and miss its earnings and kind of goes down to around $31, $30, $32 or so. So first of all, as you can see, I have two buttons here at the bottom. One says I'm bullish, one says I'm bearish. So I'm going to click on the I'm bearish tab. So what this shows me is three strategies that can take advantage of a bearish move on AT&T. I can short the stock, I can buy a put, or I can buy a put vertical. So for those of you that have never traded options before, you might be familiar with the concept of shorting a stock. It's certainly not a strategy that I generally recommend to customers because, number one, you have unlimited risk. It takes a huge amount of capital in order to short a stock. And if you're wrong on the trade, you could potentially lose a lot of money versus you can have the similar downside exposure on AT&T by simply buying a put. And because this put only cost $131, that's your absolute risk. No matter what happens, even if AT&T goes to 1,000 after earnings, you're still only going to lose $131 per contract. And conversely, here on the put vertical, this is the limited risk strategy. It only costs $111. So no matter what happens, you only risk $111. So it really is, now that we've put the three side by side, even if you were an expert at picking which strategies and where to start on expirations and strike prices, you simply don't know how they're going to perform unless you actually put the three side by side and looking at a P&L simulator like the one that we have here at the bottom to give you an idea as far as how these strategies will perform side by side so that you can really make an educated decision as to what's suitable for you. Even as an experienced options trader looking at an option chain like this, I couldn't tell you what's going to be better if I bought the 32.5 or 33 put if the stock went down by 5% in a week or 2 weeks. There's just no way to do that in your head. So what we have is a P&L calculator that says, well, what happens if AT&T goes down to 31.50? So let's say it goes down to 31.50 and earnings is on October 23rd. So all the information that I need is here on one screen. So what happens if the stock goes to 33.50 a few days after earnings? So earnings on October 23rd. So let's say that Friday, October 26th, the stock moves down to 31.50. And as I said before, volatility comes down right after earnings because the uncertainty factor of what earnings are going to be is gone. Typically, volatility will come down a few percentage points. So let's say it does that. As you can see, here are the expected returns of these three strategies. So this is delta. This price slider is that delta that I was referring to. If the stock goes lower, if the stock goes higher, how does that impact your option price? If the theta, which is time decay, is represented in how far between now and expiration do you want to hang on to this option for. And lastly, that vega piece, that volatility crush, is represented by this volatility slider. So we know that earnings volatility will always collapse after earnings, so we can dial this slider down a little. And the net result here is shown to us as to what the actual profit or loss is on our option, which is really what you're looking for when you're calculating delta, theta, and vega. So here, as you can see in my scenario, AT&T is at 33 right now. I think it's going to go down to, let's say, 31.50, I said, a few days after earnings on October 26th, and we know volatility comes down. So here, without having to do any math or having to figure out where the delta, theta, or vega, it immediately tells me that if I shorted the stock, I make a 4.6% return. If I bought this put option, I'd make a 63% return. If I bought this put spread, I'd make a 72% return. So this is how you can now make an educated decision based on where you think the stock might go as to what your, number one, what your potential reward is if you're correct on the trade. In this particular case, I think I might look at the strategy here on the right in my scenario. If you think the stock was going to go even further down, maybe you thought it was going to go down to $30. So if you think the stock's going to really take a huge dive lower on earnings, as you can see here, it's actually better to trade the put option. So depending on what your views are, that will drive which strategy is better for you. But if you were just looking at an option chain, you wouldn't be able to tell that. You have to put strategies side by side, and that's really what this tool allows you to do. Even if you're not trading earnings, you can still utilize this tool, set up different option strategies. If you were just bullish on a stock, you wanted to see how strategies will perform, this is really the tool that makes it as easy as possible and makes it so that you are definitive in understanding what your potential rewards are for each strategy, but also, what if you're wrong? How much money do you lose? So let's say AT&T is at $33 and it blows through earnings and goes up to $35 on earnings. Okay, so let's see how that pans out. If you had shorted the stock here, you lose $197. Quite a bit of loss here if you had shorted the stock. If you had bought this put option here, you'd lose $114, most of what you paid here, but at least you've limited your risk to that amount. And here you've limited to about $115. Versus if you had bought the spread here on the right, you actually lose the least amount, only $94. And that's why this strategy here on the right has the highest options play score. Options play score is telling you the risk to reward of each strategy. So how much reward do you have if you're correct versus how much risk do you have if you're wrong? And it really balances each one of the three and tells you what is the best risk to reward metric for each one of these three strategies. So that's really why the strategy here on the right has the highest options play score. And one of the best implementations that we've done here with Firstrade for you guys to make this process as easy as possible is that if you've decided that this strategy here on the right is the strategy that you want to trade, you can hit the trade button. We have what's called a strategy checklist. I highly recommend it for those of you that are brand new to options trading to make sure that you review the strategy checklist. We check the stock trend, the market trend, the options play score, the earnings date, and as well as spread and liquidity, making sure you understand all of these risks before you place a trade. And sometimes when you see this thing lit up with a bunch of reds, that's just telling you maybe this is something that you might want to reconsider. So here I've got 2 greens, a couple of yellow warning signs, and 1 red warning sign telling me that, hey, not everything's lining up for you, just so you understand your risks. If you're okay with these risks, go ahead and proceed. But this is really one of the best parts is the preview order button will actually pre-fill your ticket for you. So you don't have to enter any of these things manually because on an option trade, there are 6 things that you have to enter per leg: transaction, contracts, underlying symbol, expiration date, strike price, and call or put. So for a 2-leg strategy, you're looking at 12 different inputs. A lot of times there's a possibility you might make a mistake. So that's really why we created this tool that pre-fills the ticket for you so you know you filled it in correctly. You can put in the limit or the market order, however you want to place this trade, and then hit the preview button for a trade. So this is really where this tool is designed to make your life as seamless as possible, everything from analyzing the underlying stock, making sure you're looking at the strategy correctly, and ultimately, once you're ready to place that trade, hitting that trade button and pre-filling that ticket for you. This is all designed to make your life as intuitive as possible for the process of educating and learning about options, and then more importantly, transacting them. So that's just a quick example of AT&T. I'm going to jump over here to another example. I want to provide as many samples as possible to show you guys how to utilize this platform. I'm looking at Kellogg. This is a relatively strong stock, a technical score of 7, but as you can see, the 1-month and 6-month trend recently turned bearish. So this is an example of a bullish stock that recently started to break down. It broke down here on September 27th below a support level, and the trends turned bearish and neutral. So this is the type of stock that may be starting to turn around. So maybe I'm bearish on Kellogg again. As you can see, this reports earnings on October 31st, 3 weeks from today. So I'm going to click on I'm bearish. Again, I'm presented with 3 bearish strategies. If I shorted the stock, I have put up quite a bit of margin. Buying a put option only cost me $300. Buying this put spread cost me $210. So here I'm actually getting a significant reduction in not only cost to enter the trade, but also my max risk. So let's take a look at these strategies and see how they perform. So Kellogg, I'm going to zoom out a little bit on the chart. As you can see, had a bit of this topping formation up here and recently broke down. So I do think there's quite a bit of downside to this particular trade. It could easily hit about $66, but I don't think it's crazy for it to go down to 62, the previous low here. So those are 2 possible targets here. So let's say we think the stock's going to go to, let's say the first target around 66, a few days after earnings, which is October 31st. So maybe on the following Monday, we think the stock's going to go down to $66. And we know, again, volatility will come down a bit after earnings. So as you can see, if I had bought this put option, it cost $300, so my return is only 35% versus a 3% return if I had shorted the stock. But because this put vertical cost me almost a third less, notice how large of an impact it has on my return. Instead of making 35%, I'm making 68% return on this spread here. So there's a pretty big significant reduction in cost here, which will show itself in the returns if I'm correct. So this is a fairly modest move, down from $69 to $66, only a $3 move. This is the type of move that we saw just a few days ago when there wasn't even earnings. So if earnings were to miss, I think 66 is a fairly conservative target where I would probably consider trading this spread here. But if, let's say, I thought the stock was going to go down to 62, this is the much bigger move that I was possibly looking at. Again, this is not by any means a solicitation to trade the stock. This is simply just providing a what-if scenario as to what may happen. So if the stock goes down to 62, as you can see here, if I shorted the stock, I make a 9% return, which is a nice size return. But if I bought this put option, that's where I get that unlimited profit potential, unlimited downside until the stock hits 0, that's where I'm going to get 167% return. This is really where I can knock it out of the park if I am correct and the stock makes a big move to the downside is by buying this put option, versus if I bought this put vertical, because with the put vertical, my profits are capped, I'm only going to make 133% return. Certainly not anything to sneeze at. 133% return, I think I would still be pretty happy making that type of return on a trade, especially in just a few weeks. But this really allows me to understand what my potential rewards are depending on where I think the stock will go. And then more importantly, if the stock goes against me, what happens if Kellogg goes back to $75? That 52-week high because it beats earnings. As you can see here, if I shorted the stock, I lose $675, a substantial loss compared to buying that put option where I'm losing roughly $300 versus the put vertical where I'm losing roughly only $200. So here I'm losing about half the cost of buying, shorting the stock, and here I'm losing about a third of the cost of buying shorted the stock. So this is really why we encourage users, if you're going to play earnings, which, like I said, not everyone's going to play earnings. This is not necessarily suitable for everyone. It certainly is high amount of risk. However, if you're going to take that risk, use options because it's going to allow you to take advantage of that move if you're correct. But way more important than that is being able to limit your risk if you're wrong, okay? So if you're just buying or shorting a stock before earnings, you're opening yourself up to the same amount of risk to the downside as you are in potential upside. And that's not something you want to do if you have the ability to limit your downside risk. And the way to do that is by buying calls or puts. And lastly, if you're ready to place this put option because you think the stock's really going to take a move lower, hitting the trade button, reviewing the strategy checklist, as you can see, you're trading with the trend of the stock, trading with the trend of the market. The options play score is very good. Be aware that there's earnings. We're okay with that because we want to trade that earnings. And lastly, the spread and liquidity. So if everything checks out, all you have to do is hit the preview order button. It will pre-populate the ticket for you so you can send this off for execution immediately. So lastly, I have a few minutes left, so I want to go through one last example. I'm going to go through a bullish example here. Again, by no means am I soliciting you taking a look at CVS or trading CVS. This is just one of those healthcare stocks that recently have been doing quite well. Certainly held up pretty well in today's market environment when the markets were down about 3%. So let's take a look at what happens if CVS really does well going into earnings, which reports earnings on November 6th. Let's take a look at this trade. So CVS is currently trading around $78, $79. As you can see, it's got a 52-week high of around 84 or so. So I think that, from a target perspective, I think that's a fairly conservative target to shoot for if you are bullish on CVS. So again, I have two buttons here on the bottom. I can click on I'm bullish or I'm bearish. Either way, I'm presented with 3 strategies. This is really designed for those of you that are brand new and not sure where to start in terms of picking expirations and strike prices. This does that for you and provides some starting points so that you can say, well, I'm bullish on CVS. Traditionally, I buy 100 shares of that stock. That's going to cost you $7,800. Conversely, you can buy a call option that gives you that similar upside but limits your downside to only $340. Or you can buy this put spread, which gives you some upside to a certain amount, but reduces your overall risk down to $283. So let's actually compare these 3 strategies. CVS is trading at 79. I think it's going to go to 84. And we said that we might do that a few days after earnings. So earnings is on November 6th. So maybe by the end of that week on November 9th, we think that stock's going to go up to 84. And again, we know volatility will come down a bit after earnings. How did the strategies perform? If I bought the stock, I make a 6.5% return. If I bought this call on CVS, I make a nice 64% return. And this is on a fairly modest $3 move, or I'm sorry, this is about a $5 move on CVS. But if I bought the spread, I make a 77% return. So out of these 3 scenarios, I think 84 is probably a likely target if I'm bullish on this particular symbol going into earnings. I think I might be probably looking at this spread here on the right. However, if let's say you were more bullish and you thought it's going to go to 88, that's where the call option may be better suited for you. But I think, in my opinion, that's probably a little bit overextended. And I think some people might even argue that it might not even go that far, maybe only 83 or $83. So as you can see here, this really allows you to play around with this, enter different scenarios, and see what the expected returns are. So let's say you think it's only going to go to 82. As you can see, you make a 4% return on the stock, 11% on the call, 26% return on the call spread. None of these look particularly attractive if you only think the stock's going to go to 82. But what's more important is that if you only thought it's going to go to 82, that's going to help you decide that probably none of these strategies is best suited for you. That's really the goal of options play. It's not necessarily for you to place an options trade, but more importantly, making sure you understand what your potential rewards are so that you can decide either to trade it or not trade it. But on the same token, if you're wrong, how much money do you lose? With good traders, we're always concerned about how much money we can lose because that's really what hits our bottom line. We want to understand our risks before we get into a trade, and options play really helps you define what your potential rewards are, what your potential risks are, so that you can definitively say, am I getting enough reward for the risk that I'm taking? Because that's a question you should be asking yourself before every single trade. And once you're ready for that, you just hit the trade button, preview order, and it will pre-fill the ticket for you so you can send this off for execution. This is really designed to make your life as easy as possible. And for those of you that are a bit more advanced, for those of you that have traded options and maybe have even traded earnings before, if let's say you decide you want to change the expiration date or strike price, all you have to do is hit the modify button. You can change the expiration date by clicking on the left or right arrow or using the drop-down menu. And you can move all the strikes up one or down one by just clicking on the arrow button. And that allows you to shift the strike prices up or down. So for those of you that are a bit more advanced, maybe you might want to take a look at in the money option instead of an at the money option. As you can see, that provides slightly better returns. So depending on what your views are on the underlying stock, this really allows you to play around with these strategies. That's why we call it options play. And I highly encourage, especially for those of you that are brand new, take a look at options play as a starting point for you so that you can get some ideas, understand what the starting points are, compare the three side by side, just so even as a learning process, so that you can learn more about these strategies and most importantly, understand what your potential risks and rewards are before you get into a trade. So with that, that covers what I wanted to teach you guys here today with respect to what earnings are, how to manage them around earnings, and most importantly, how to analyze them using options play. So at this point, what I'm going to do is I'm going to open this up for Q&A. If you have any questions, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for today. Aaron's asking, for buying options, it's not to hit strike price so I can buy the actual stock, right? But it is to make profit by the trade price moving up or down. Is my understanding correct? Aaron, your understanding is absolutely 100% correct. So when we buy this call option here on CVS, the November 16th 75 call that costs $535, the goal is to simply have this option go up in price so that we can sell this later for more than $535. It's the same thing like buying a stock. When you buy a stock at $78, you want the stock to go higher. It's the same thing when you buy an option for $535. You want that option price to go higher so that you can sell it at a profit. It's the exact same thing. For these strategies, do you need to have the underlying stock? So no, you do not need to own any underlying stock in order to trade any of these strategies that we talked about here today. You can buy an option. You don't need the underlying stock. The only time where you need the stock is really when you're selling an option. But today we're only talking about buying options here, so you do not need to own the underlying stock. I want to see delta in the option chain, not a part. I think you're saying that there's no delta in the option chain. That is unfortunately one of the limitations of the option chain. So that's really why we encourage you to take a look at options play. And if you want to find the delta of an option, we have the delta right here. So as you can see, the November 16th 75 call has a delta of 71. So for every dollar CVS goes by, this option will go up by $71. So this costs $535. CVS goes up by $1. You will make $71 profit on that trade. So that's what delta tells you. From options play, can it show you the option you're buying on the option chain? So the two are not connected. So unfortunately, you cannot see what you've bought on the option chain. Aaron is asking, let's say if a call option I bought did hit the strike price, the option expired, what will happen to my option? And can I only buy half of the contract? So first of all, let me answer the second half. You cannot buy half a contract. You can only buy full contracts. With respect to what happens if you bought an option and it hit the strike price at expiration, that depends on what Firstrade does. But I'm pretty sure that what ends up happening is they will exercise your call and you will own the stock at the strike price. But you should talk to your Firstrade representative as to how they handle option expirations. But most brokers will exercise that call for you. Thank you very much. I really appreciate everyone taking the time out, every few weeks to come to us. We are moving this to a much more regular schedule. So every 2 weeks, we're going to be back doing webinars for you guys, going through all different types of trading strategies, beginner strategies, more advanced strategies, technical strategies, buying strategies, selling strategies, everything that you can think of, we're going to cover to really making sure that regardless of what type of options trading you like to do, that we provide some type of education for you guys and teach it to you on the platform that you guys actually use for trading. And that's really the benefit of using Options Play when we teach you, is because right after you're done, you can log on to Firstrade and use the same platform that we're teaching you. And you can use the recordings of these webinars afterwards as kind of your guide as you learn, as you go along. I don't expect everyone to memorize what we've taught here today. That's why we've recorded these webinars so that you can view them afterward. How dynamic is this? You're looking at a strategy. By the time you want to trade on it, what are the risks that has changed? So depending on your account, so many of you are entitled for real-time quotes, which means that the quotes that you see on your screen are real-time. Option pricing usually doesn't move as fast as stock pricing, so that's usually why it's not as time sensitive as trading stocks. And we just posted a link in the chat window. So for those of you that want to take a look at the recordings, please click on that link and you'll be able to see the previous recordings that we have and this one that will go up probably by around tomorrow. So please take a look, and I want to thank everyone for taking the time out this afternoon. I have one last question. Charles is asking, what is POP? POP tells you the probability of profit. So what is the probability of CVS being above the break-even price, which is $80.35 at expiration? So CVS is at $78.92. What the question is, what is the probability of CVS going above $80.35, which is the break-even price of this strategy? And that is around 40%, and that's what POP tells you. So thank you very much. I hope everyone found this webinar useful. Please send us your feedback and questions. If you have any questions, you can contact Firstrade customer support and they'll be able to help you out, and make sure you take a look at these recordings. We do these recordings for you guys to teach you guys how to trade options. And most importantly, we teach it to you using the tools that you guys have access to. So I hope you guys find this useful, and please have a great afternoon, and I'll see you guys in a couple of weeks.